Well, investors are digesting a new report from the Wall Street Journal saying that the Federal Reserve is getting ready to cut interest rates by a quarter percentage point at its policy meeting later this month. Joining us now is John Tamny, director of the Center for Economic Freedom at FreedomWorks. John, great to have you back on the show. What would happen now that investors are anticipating this if the Fed didn't cut interest rates?
Oh, I suppose there'd be a little bit of surprise in that certain aspects of the market respond to this, but I don't think there'd be any major economic impact. And my evidence is something else that was on the front page of the Wall Street Journal today. You saw that Apple recently floated $7 billion worth of bonds at rates lower than 3%. Does anyone, so when you think about that, does anyone think that if the Fed suddenly jacked rates up 200 basis points, that suddenly Apple's cost of credit rise in some substantial way? The reality is credit is set in the free marketplace. The Fed can't control this too much. And so when it plays around with rates here and there, there's not going to be some huge economic impact. Apple will always be able to borrow cheaply, so will Amazon. Something like Blockbuster, if it still existed, would have to pay enormous interest rates to borrow.
Okay, I want to go back to the minutes that were released last month, and they reflected a sentiment that I think the Fed wants to really drill home into investors' minds, that the rate cut that we saw, it was not a start of a trend, right? They wanted to be very, very clear that it wasn't, going to be forever and ever, and that wasn't going to keep happening. But this report, this latest one now, seems to conflict that kind of thinking, no?
Yeah, it does, and I think it speaks to the confusion on the part of central bankers and this notion that they're important to the economy. Look, if central bank lowering of rates could somehow stimulate economic growth, someone must eventually explain to me why it never worked in Japan. In the same way, someone must explain why it's not working in Europe. But of course it doesn't work, because if central banks were this powerful, if they could quite literally decree economic growth by fiddling around with an interest rate, the U.S. economy wouldn't be worth talking about in the first place. The reality is the Fed can, quote, ease, but if the economy's weak, the global credit system, which in its really and truly global, if there's weakness, it's going to pull back. It's going to limit what flows into the United States, which would mitigate anything that the Fed did. So I just think we've got to move on from this idea that the Fed can create good outcomes. If it could, that would be very dangerous.
So what message do you have for President Trump, who really just over the last year has not even given a break to Fed Chair Jerome Powell, just railing on him, not lowering interest rates fast enough? What message do you have for the president?
It's a great question, and I'm glad you asked it. What I would say to President Trump is, why do you insult your economy? Why do you insult the Trump economy so routinely by pretending that it's reliant on what 9 governors do in Washington with interest rates? The U.S. economy is far too dynamic, far too advanced to be reliant on the tinkerings of some central bankers in Washington. If the economy is growing, as you say it's growing, don't worry about interest rates, because credit flows into this growth will come in from around the world. Just the same, assuming the economy is weakening, which you allude by worrying about the Fed can't alter that outcome. And I would say, thank goodness it can't alter that outcome. To say that it could would mean that we could continue to prop up the past, that we could basically prop up AOL at the expense of Google, that we could prop up Friendster and MySpace at the expense of Facebook. Economies grow based on the replacement of what doesn't work. If you don't have economic slowdowns that rid you of what was in the past, you can never have major growth.
Right, and I think from many analysts' perspective, the Fed is a punching bag, or at least, the antagonist to President Trump, some group and some person that he can kind of blame for whatever is happening in the economy. I'm going to switch gears over to Apple. You mentioned it at the top of the interview here. Selling bonds now, $7 billion now, for the first time in a very long time. Why do you think Apple needs to do this right now?
Well, because it's a good way for Apple can basically float a fair amount of debt, and what this means is that it doesn't have to expose some of its global earnings to taxation. Figure that interest on debt can be tax deductible, whereas if you, quote, repatriate money from around the world, you're potentially going to have a big tax hit. So it's only logical that Apple would do it. It's a reminder that money, remember, you all may remember a couple of years ago, people were saying there's $2 trillion stranded overseas. No, it was never stranded overseas. The money's constantly flowing back in and into places where it serves a use. This is Apple's way of doing it without incurring a tax hit.
So in terms of tax policy, John, what do you think this says about U.S. tax policy? Because the Trump administration in the Tax Cut and Jobs Act did change the way that companies can bring cash back to the United States. Did that not go far enough?
Let me be clear. I am always for tax cuts, but I thought the repatriation aspect of the 2017 tax bill was a laugh line. The reality is that money was already here if it had a purpose to be here. And the Apple example is just one of many examples showing how if there are tax barriers to bringing money back into the United States, you can get around them. Apple did it and does it by floating debt. So I had a real problem with the repatriation aspect of it because it wasn't, oh, hey, if you bring money back in, you're going to have a lower tax rate. Remember what that was? It was you are going to bring the money back in, and for doing so, you are going to face a lower tax bill. So I thought whenever Republicans are going in the direction of we want more tax revenue and we are going to force an outcome, we're just going to lower the cost of you bringing the money back, I think that's always dangerous. Republicans should be, instead of about raising taxes in certain ways, reducing the barrier, reducing that burden.
It's so funny to hear $7 billion for Apple, because for Apple, that's just a tiny amount of money. I mean, it's just a fraction of the cash that the company has on its balance sheet. John Tamny, Director of the Center for Economic Freedom at FreedomWorks. Always great to see you. Thanks for joining us today.
Thanks for having me.